Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. And today we are tackling a big obstacle for particularly for a new options trader, and that is there are dozens and dozens and dozens of option strategies to choose from. So how might a trader choose just one for their convictions regarding current market conditions? Well, today we're going to be going through a three-step process, asking ourselves three big questions that might provide a lot of clarity for which option strategy a trader might select. I think it's going to be a good discussion. Before we get to that, though, let me first of all say hello to everyone who's already chatting in out there on YouTube. Great to see all the familiar names. Hello to anybody that might be new. But hi there, Lawrence and Paul, Eva, Waylon. Who else do we have? George, Miralai, Gary, Marcus, Richard, Mark, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you are among those who are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy that recording. It's a great way to watch these webcasts, but you're certainly invited to join us in the live stream audience. If you'd like to be here, we kick things off promptly at noon on Tuesdays. Now, I also want to let my live stream audience members know that my very good friend Kevin Horner is going to be hanging out with us today. He's going to be keeping an eye on the YouTube chat, and he's going to be catching any questions that come in. If I can't get to those questions, Kevin's there to pick up the slack for me. Thanks for having my back there, Kevin. Kevin and I would also like to issue an invitation to everybody watching to follow your favorite Schwab presenters on social media. You can find us on X, you can find us on LinkedIn, so you can find Kevin on X at Kevin Horner CS. You can find me on X at Cameron May CS, or you can jump over to linkedin.com/in and then /Cameron May CS. That's my handle there. You can give me a follow, and if you reply to my posts on social media, I just try to reply right back to you. All right, but let's get into this discussion of selecting a single option strategy out of the dozens and dozens and dozens available out there. And of course, as we do, we need to consider the risks associated with trading options. So bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And any investment decision you make in your self-directed account is solely your responsibility. All right, so with that said, let's set the agenda for today's discussion. So we do have a big issue to tackle, and that is lots of strategies to choose from. How might a trader pick one? So what we're going to do today is we're going to look at current market conditions through the assistance of three charts that may help us address three big questions that might help to whittle down the range of option strategies that one is selecting from. So I'm going to outline what those questions are. We're going to use those three charts that might assist with answering those questions, and that hopefully will guide us toward an example trade for the day. Just one strategy to select out of all those potential strategies. So let's go right to the Thinkorswim desktop platform. And the first thing I want to do here on the Paper Money platform is to outline these three big questions, this three-step process for narrowing down the field of potential strategy candidates. So question number one, I want to determine are current market conditions and are the conditions expected for the time frame of the trade bullish, bearish, or neutral? That's going to be question number one. Number two, does it appear to be more of a buyer's market for options or more of a seller's market? And number three, is the trader looking for a strategy that offers very high reward potential that they intend to leverage, or is their preference for higher probability? There we go. So those are our three big questions. And just answering these three questions, different strategies are going to suit the answers to these questions very differently. And so we're going to start off with theoretically dozens. There are dozens of bullish strategies, dozens of bearish strategies, dozens of even neutral strategies. So we're going to start to whittle those down by, first of all, addressing this first question. And when I say bull, bear, or neutral, we might want to ask ourselves this about current market conditions because, and specifically I'm talking about the stock markets. Because let's put ourselves in the shoes of a trader here who's about to go out and place an options trade. And maybe they're looking out to maybe this September 18th expiration. So over the course of they're planning a trade here that might run about 3 weeks. Well, what's their outlook for markets? Are they expecting the markets to be higher or lower or primarily neutral for that time frame? Because if we're in the habit, no matter how gifted we believe we are with options trading, if a trader is habitually placing, let's say, bearish trades when the markets in general are persistently bullish, that can be tough. As good as the trader might think they are, that can be a difficult prospect. Now, on the other hand, if we're placing bullish trades, how many of us have noticed this? If the markets are cooperative, just it seems like those bullish trades, I don't want to say can't miss, but boy, it seems to help a lot, doesn't it? Yeah. So just getting market conditions dialed in might be the biggest of our 3 steps. So let's look at the stock markets and let's ask ourselves this question. All right. Let me frame it this way. Let me give you an assignment. Let's look out here from today out to that September expiration and putting yourselves in the shoes of our trader. Do we think that the S&P 500 is likely to be higher, lower, or mostly sideways? Well, let's start to gather some technical evidence here. Is there anything that catches your eye? One thing that a trader might note is that there was a price ceiling around that 7,600 level for this stretch of about 3 months. It looks like the S&P was just really reluctant to get above and stay above about 7,600. Let me throw in a line there, right about there. I think you can see what I'm talking about. I'll get that as close to 7,600 as I can. That'll work. But you can see how, yeah, the S&P just really never settled above that until this big, strong day there on August 4th. We pushed up and through, and an assumption by some technicians might be that that's likely to act as a new price floor or a new overall prices floor. It's not a guarantee, but that might be one piece of technical evidence. For those that use Fibonacci's, let's throw on a Fibonacci here. Let's go to this recent high. Click right up there. Let's move to the bottom. And interestingly, our 50% line is settling right in at that level. If you don't know what a Fibonacci is, you can actually learn about these. Just go to our channel. If you're new to our channel, welcome. It's great to have you here. Make sure that you're subscribed. Just pop down below the video, click on the subscribe button. It only takes a second to do it. Doesn't cost anything to do that. But our Trader Talks channel on YouTube is where you can join these live streams. You can find playlists of previous webcasts, or you can even do keyword searches for topic of specific interest. So like if this is your first exposure to this technical approach known as Fibonacci's, let me just type in Fibonacci, and you'll see right here several discussions I've had in the past. Here's one that I would suggest for those that are brand new to this: Beginner's Guide to Using Fibonacci's to Trade Stocks. That'll explain what this is, but it's basically just a tool that's sometimes used by technicians to identify potential price floors and price ceilings when they're not otherwise obvious on a chart. Okay, so let me remove that. I'm going to unclutter this. Overall, though, let's just say that our trader suspects maybe after this strong move to the upside, there's been some profit taking, and possibly the S&P 500 and its component stocks have kind of settled in. And let's say that the outlook, our traders expecting prices to go higher from here. Is that a guarantee? No. But if it does, that can really provide a bit of a tailwind to a specific category of our strategies here. So what we're going to do in answering our first question is, let's, for today's discussion, remove bearish strategies from consideration and neutral strategies from consideration. And that is a massive step forward in narrowing the field of potential strategy candidates. If some are bullish, some are bearish, and some are neutral, we just took about 2/3 of those strategies out of the equation just by addressing this one question. Now, what we'll probably want to do is make sure that our outlook for our individual stock that we select for trading options on, we want to make sure that that is consistent with this bullish outlook. All right, but that's question number one: bullish, bearish, and neutral. Big assist, probably the most helpful in narrowing our field of candidates. However, there are still lots of strategies left to choose from. Now, about half of those are going to be buying strategies. About half of those are selling strategies. So let me explain that. If we're bullish on the markets, on a stock, well, as a basic, one of our simplest strategies, or just the least complicated, is we could buy a call. That's bullish. Or we could sell a put. That's also bullish. So does it appear to be more of a buyer's market or more of a seller's market? Now, we can do all sorts of variations on the theme of buying calls or selling puts, but both of those are bullish strategies. So how about we go look to see, does it appear to be more of a buyer's market or more of a seller's market for options right now? That might help us narrow the field of candidates further. Let me throw that question out to you again. What do you think right now? Does it appear to be more of a buyer's market or more of a seller's market? I know a lot of you feel pretty comfortable in answering that question right away, especially as we look at where things are right now and where might the trader expect things to be, let's say, a few weeks from now, as that September 18th trade time frame is closing out. Buyer's market or seller's market? Well, how can we check on that? For our first question, we were checking on stock market conditions. This second question is really more specific to options market conditions. So we're going to switch our chart to a chart that might assist with that. And this is the VIX. VIX is the chart symbol. And this is a chart of the anticipated volatility of the S&P 500 for the next 30 days, basically. Why does a trader care about volatility? Because volatility has a large impact, or can have a large impact, on the pricing of options. Just generally speaking, if this chart is high, that kind of highlights area or time frames when traders are expecting a lot of volatility to come from the S&P 500. And when there's a lot of volatility expected, that can drive options prices higher. Speculators might see potential in all that volatility. Hedgers might see risk. Either way, speculators might buy more contracts in an effort to take advantage of volatility. Hedgers might buy more contracts to hedge positions in their portfolio, but demand can get pressed higher in highly volatile conditions, or even just when the expectation is highly volatile, and options prices will tend to rise. So when this chart is high, options prices tend to be high across a lot of strikes on a lot of stocks out there. And when this chart is low, options prices tend to be low. And then if we just look at this through the lens of buying versus selling, do we typically like to sell things when prices are high or sell things when prices are generally low? Yeah. Higher volatility is typically described as a seller's market, especially if it's high and falling. When we have low and rising volatility levels, that can generally be described as a buyer's market for options. And that seems to be where we are right now. It doesn't mean that we can't go lower. However, there hasn't been much. Let me just draw a line in here. Let's go right to where volatility levels are right now. Let's just draw a line back through the last 12 months. And you can see, really, volatility has not settled much below where it is right now. Options prices in general have not been much lower than they are right now over the last 12 months. Maybe for short periods, maybe a little bit lower, but not a lot. So Eva says you would say it depends on the individual underlying. It can. Yep. With this, just like with the S&P 500, if we say, ooh, it looks like the S&P is bullish, therefore, can I go out and just trade any old stock because they're all going up? Nope. It's just a sort of getting the fingers on the pulse on what's generally happening. That would also be an accurate statement for this volatility index. If volatility is low, that might mean that most options on most stocks are lower priced than at most other times for the last 12 months, but there are certainly going to be exceptions to that. Yep. But overall, let's say that our trader has looked at the S&P and determined markets look bullish, at least for the expected time frame for the trade. They've looked at the VIX and they've determined that it appears to be more of a buyer's market. So bullish, well, buy calls or variations on that theme, that would be bullish. Sell puts or variations on that theme, that would be bullish, but we're just not going to do any bearish or neutral strategies. That's narrowed the field down. The second question, looks like buying calls or variations on that thing, more of a buyer's market than a seller's market. All right. Now, and again, that's under the assumption that volatility levels or anticipated volatility levels rise somewhere higher than they are right now. That can provide a tailwind again to the prospects for this trade. So we've narrowed down that field substantially. No bullish, no bearish, no neutral, just bullish. Among the bullish, we just eliminated half of those, and we have our buying strategies. Well, among those remaining bullish buying strategies, there are some that are going to be inherently higher reward but low probability. There are others that are going to be inherently lower reward compared to our high reward strategies, but higher probability. So this might be the final question that our trader asks themselves. What am I looking for? Do I prefer high reward, but am I also open to the idea that these high reward trades don't work out as often? Or do I prefer higher probability, more frequent success, but maybe less reward for being successful? That's a decision up to the trader. It can change from one trade scenario to the next. It doesn't have to be absolutely consistent from one to the next. But let's do a comparison. And for this one, we're going to use a third chart. SPX was our example chart for number 1. VIX was our example chart for number 2. Our third chart is just going to be the stock chart. So I'm going to bring up as our example trade for the day, Netflix. Let's say that our trader is looking for a stock whose outlook, at least for the time frame of our intended trade, seems to match their expectations for the S&P 500. In other words, they expect the stock to go up. And some technical evidence supporting that sort of a premise here. Again, not a guarantee, but Netflix has gotten kind of punished over the last 12 months. It's not been one of the hottest stocks. It was just very recently making lower highs and lower lows. However, since that last earnings announcement, it's turned a bit of a corner. And you can see over the last 6 weeks or so, we've been making higher highs and higher lows. Maybe I ought to say that, yeah, maybe 6 weeks, maybe 5 or 6 weeks, we'll say. We've started a potential recovery process. Could this be this stock starting into a new extended upswing? Possibly. Now, the trend in the short term seems to have strengthened, but also we've recently pushed through previous highs. Looked like there were highs right around that 79 level where the stock just kind of struggled to advance. And then just a week ago, we pushed up on a particularly strong candle day, and that looks like it might be a new price floor now. At least it's acting that way over the last few days. And even today, getting some strength when the markets are kind of having a ho-hum sort of day. So let's just say that our trader thinks, it's their premise here, that Netflix is likely to go up. Now they have to make this final decision here though. There are some traders that might look at this scenario and say, boy, it looks like there's some room to go here. This stock could just continue to run like it did over the last few weeks. Maybe if it does that for a couple or 3 more weeks, we could go from $82 where we are right now, maybe up to 90 bucks, 10% increase in the stock price. If we leverage that with, let's say, just a long call option, that could carry substantial upside reward potential. So maybe the long call is on the table for consideration. Let me ask this question. Got 2 questions for you about the nature of long calls. Number 1, what's the ultimate reward potential of a long call if we just buy a call option? How much can theoretically be made? In 3 weeks, in 6 weeks, in 2 months, whatever. It's unlimited. If we buy a call, the higher that stock goes, the more that call can theoretically make. It has a strong reward potential. Some traders are really attracted to that. And if they really think that a stock is going to go for a substantial run, that may tilt the scales for them toward this higher reward scenario. That might be the strategy they prefer to choose. However, what about the inherent probability of long calls? I can make a statement of fact here. Long calls are low probability. So are long puts, but we're talking about calls today because we're bullish. If we buy a call option, doesn't matter which stock, doesn't matter which strike, doesn't matter which expiration, that call starts off with a lower probability of success than failure. And that's because of a couple of influences: time decay and the difference between the bid and ask price. There's what's called slippage right at the start of a trade. It also is present at the end of a trade. If we go to close out a long call, we can see some slippage just in the liquidity of the option. But in any case, I don't make absolute statements very often, but in my experience, if you can find an exception for me, all long options are inherently low probability. So lots of reward potential, but the percentages from one trade to the next are not necessarily in the favor of the trader. Now, I know that I've heard some traders make the argument, yeah, Cameron, yeah, but that's not right because I'm really good at picking stocks and picking strikes. Okay, that's fine. That doesn't change the math of the probability of the trade. Yep, Eva says long anything is generally low probability. Fairly accurate, Eva. Depends on what anything is, because I'm going to show that we can actually use a long vertical spread that's high probability or higher than just buying a long option. And we can just call, if we define it as better than 50-50, yeah, we can say that we can structure a vertical spread to be higher probability. But let's do a comparison here. Let's go to our trade tab. Let's say with our, let's see, where was our support? It's at 79. What if we were to buy, let's say, an in the money call? Let's go down to maybe like the 77. Let's go to the trade tab. Let's go out here to the 18th of September. And let's look at maybe buying the 77 call. That looks like that's trading between 570 and 615. Let's say that we're able to buy that for $5 and, what should we say? $5.95. Oh, yeah, you're exactly correct. Yep. Yeah. We can say if it's just a long option, no short options involved, just buying those options. Yep. Those are inherently low probability. So you're exactly right. Yeah. If we buy that $77 call, looks like it might cost us, I'm going to say it might cost us $6. It actually just went up a little bit in price. Ooh, we missed that. Anyway, if we buy that at $6 and the stock goes higher, well, we've locked in our the right to buy shares for $77 per share. And if those shares go to $90 per share, we still have the right to buy those shares for 77. If those shares go to $100 per share, we have the right to buy those shares for 77 through the 18th of September or for the next 24 days. That would be the deal. But from the moment we place that trade, time decay kicks in. And boy, it keeps going up in price. That makes this look good if only we were already in it. Anyway, yeah, unlimited reward potential, lower probability of success. Now, let's modify this a little bit. Let's say example trade A would just be our long call. It has unlimited reward. Actually, let's write it out this way. Reward potential. I better get the word potential in there. Is unlimited, but the probability is low. let's look at example trade B. A long call vertical spread. Let's stick with that same expiration. So let's outline it this way. Let's say we're going to buy the 18th of September, $77 call, and that is it still trading around $6? Look at that, it keeps creeping higher. It might be $6.10 at this point. But let's compare that to a long call vertical spread. Just to be consistent, I'm going to use the same strikes or the same strike. Let's look at buying the 18th of September 77 call for 610, but at the same time, let's sell another call to create a vertical spread. So the 77, how wide should we go? Let's go a couple of bucks. Let's actually go to that 79. That's where our strike, that's where our support is, $79. And how much would that cost us right now? Somewhere between 460 and or how much can we sell that for, I should say. Somewhere between 460 and 470. Let's call that 465. So we sell the September 79 call for 465. What does that do for this trade? Well, it does two things. It dials up the probability, but it reduces the reward potential. What is the theoretical gain on this trade? In other words, the potential reward. Well, if we do this vertical spread, we're paying $6.10 for the right to buy shares for $77, but we're accepting a payment of $465 or $4.65 that obligates us to maybe sell those shares for $79. So if these contracts, if we exercise our right to buy for 77 and someone else assigns their right to buy those shares from us for 79, that would be a $2 reward minus, how much did it cost to set this trade up? 610 minus 465. It cost us, what, $1.55 to set this trade up? Yep. How much does that leave us for profit potential? 45 cents. Is 45 cents less than unlimited reward? Yep. That's a whole lot lower reward, but also our probability is in the favor of the trader here. You might think, Cameron, why would anybody settle for 45 cents? Sounds so paltry. It sounds like it could just easily be dismissed. Well, actually, this is still a relatively substantial reward potential compared to how much we have tied up in this trade. How much is this trade costing us net? 610 spent, 465 received. This is a $1.55 trade. And if this trade goes well, we might make 45 cents on a $1.55. I don't know about your math, but mine says 45-cent return or reward on a $1.55 is a 29% return in 24 days if this trade works out. It's not that this is a tiny trade, a tiny reward potential. It's actually a very high percentage reward potential, but it's certainly not unlimited. Okay, so what's the actual probability here? What's the probability of making our full reward? Well, in order to do that, we need the stock to be above $79 as we approach that 18th of September expiration. If it helps, let me map this out on the chart. We have one strike at the $79 level. Let's draw in a second line at the $77 level. That's our other one right there. If that helps to visualize it, these two lines now represent our two contracts. And where we need the stock to be as we're approaching the 18th of September is above 79. We need it to be up here. It doesn't matter where, just higher. And if you'll notice where the stock is right now, it's above 79. And it's actually been getting higher above 79 as we've been talking. So if the stock goes up from here, if it goes up, if it goes sideways, even if it retreats a bit, as long as we're above 79 as we get toward expiration, all of those lead to most likely the same outcome, and that is our maximum gain. If the stock's up here at, even if it just goes sideways, if it stays at 82 bucks, up, down, sideways, whatever, if it's worth more than $79 and someone has the right to buy shares from us for $79, are they going to do it? Yep. Almost, well, very few exceptions. At or before expiration, the other trader says, Cameron, I want those shares for $79 because I can sell them somewhere else for 82 or 85 or 90 or whatever. Great, we sell them the shares, and at the same moment, we buy those shares for 77. Buy for 77, sell for 79. That's a $2 return of value on a 155 investment, or in other words, a 45-cent profit. That is a high probability outcome. That's probably what's going to happen. I can say that. If we look at our trade tab, there's actually a number that gives us the mathematical probabilities of this outcome. Let's look at the delta. You see the delta here next to our 79? Delta can tell us a couple of things. It can tell us how much the option might change in value as the stock goes up or down $1, but it might also tell us the probability that a contract expires in the money. Or in this case, there's a 71, 72% chance that the stock is above $79 at expiration, and this trade works out. So if our definition is high probability means better than 50-50 chance of maximum gain, there's a 71, 72% chance of maximum gain. So this is a high probability outcome. There we go. So we can just say that, depending on how this vertical spread is structured, we can make this into a high probability trade. Now, we could have selected other strikes. I'm not going to do that today, but vertical spreads are highly customizable. If we wanted to dial up the reward potential to be more than 45 cents, we might need to choose some different strikes that also will reduce the probability of the trade. That's the way it goes. It's a teeter-totter effect. But which one is the right choice here? Here's what I want to throw out as the bottom line question for our trader who just has this final question to answer before they go place the trade. Should they go for the higher reward? Because if they buy a call and the stock goes shooting up, the one who did the vertical spread might be thinking, I got to settle for my 45 cents. In this case, if they really want that unlimited upside potential, but they're willing to accept the fact that there's a lower probability of generating profits just by buying calls, they might go for the higher reward. Another trader though might say, Cameron, I like the probabilities here. 72% chance that I'm going to make 45 cents on my $1.55 or a 29% return. That looks good to me. I'm willing to draw the line in the sand. 29% is adequate for me. I prefer the probability of the trade. That's exactly right, Paul. The right choice is up to the trader. It might come down to how convinced are they that the stock is going to make the move that they're anticipating. And if they're highly convinced, maybe they take the risk, go for the lower probability, but for the higher reward. If they're a little less convinced, a little bit iffy, maybe they choose this other one. Now, I'm going to go place this trade, and actually what I'll do today, I'm going to go for the higher probability trade. We're going to do our vertical spread today just for our example order. But I do want to try to take some of this pressure off. I know that there can feel this, it can feel like we have all of these different strategies to choose from, and I have the pressure of picking exactly the right one or I'm going to blow everything up. Not necessarily, right? If with both of our traders, if trader A chooses to buy the long call and trader B chooses to buy the long call vertical spread, and then the stock goes ahead and blasts off, who's going to make money here? They both will, most likely. Yep. The long call trader might make more, but it's not like the long call vertical spread trader completely got left in the dust and didn't make anything. They both worked out. Matter of fact, if we just bought the stock and the stock went up in price, probably made money there too. It's just that there are lots of different bullish strategies that would very likely do just fine as long as the stock behaves bullishly. It's if it doesn't behave bullishly, if it starts to falter, time decay kicks in more, fewer of those strategies are going to work. The more aggressive strategies are probably going to not work. The more conservative strategies with the lower reward potential will still stand the better chance of making money in that scenario. Now, on the other hand, if the stock collapses, who loses money here? Both very likely do. All right, so let's go ahead and place our trade. How do we place this long call vertical spread? Let me show you a quick way to do this. There are a couple of different ways that we might place our order. Let's go to the option chain. Let's select the expiration that we've been eyeballing. One way to place our vertical spread is actually just to hold down the control key on our keyboard and start clicking. Here's what I mean by that. If I hold down the control key, and you'll be able to see that there are some hotkey prompts, numbers that pop up here, up at the top of the screen. That's just your sign that I'm holding down my control key. You can also see a sort of a circle around my cursor. Anyway, but if we're holding down our control key, what we can do is go to the strike price that we intend to buy and click on the ask. That will create our buy order. Let me just hide this left column. We don't need that anymore. And then if we go back up to our options chain, I'm just going to tuck this order away for just a moment. Click this little down arrow. It just moves, our order still there. It just hides it for a moment. But if I hold down my control key and I then click on the bid price for the contract I intend to sell, it adds that to the buy order. And there's our vertical spread. 77.79. Looks like it might be about $1.53 debit. I think we were calculating $1.55, so maybe we could move up our limit order to that if we're willing to spend a little bit more because the stock seems to have moved a little bit higher as we were talking. Maybe we move that debit that we're willing to spend up to $1.60. That's one way to place that order. But one other way some people don't know about is right up here where it says spread single. When we have a single selected here, it shows us all the individual strikes so we can just trade single legs. If I click on that, we can choose deep and wide. How many of you have used this deep and wide feature before? I'm going to go to deep and wide, 1 month, 2 strike, vertical. This is what this means. We're telling the system, hey, both of these contracts are they have the same expiration. It's just 1 month that we're dealing with, 18th of September. In other words, the September contracts. But these strikes are 2 strikes apart, and I want to trade a vertical that's 2 strikes apart in the same month. So if I choose vertical here, you'll notice it pairs up these strikes, 1 strike increment with the next one that's 2 strike increments away. So the 77 with the 79, the 78 with the 80, and so on. And then if I want to buy a vertical, I can just go to the ask price and click on that ask price, and it creates that same buy order. Bogus Chinchilla, you've used this before? Yeah. That's a nifty little tool, but so is just holding down the control key. Doesn't matter which way. It doesn't not like we're saving money one way or the other. It's just a click here or there that might be saved. Anyway, but how about, let's say that we're willing to spend that $1.55. That's a little bit off the mid price, not entirely on the natural. Might be improving our odds of a fill here a little bit, but anytime we use a limit order, there's a risk the order might not fill. The trader needs to then calculate how many contracts they're willing to get into. There's an initial cost. This trade would cost us $155 plus commissions for each contract pair. But also we just have to remember other associated obligations. If we have a call, if we have a long call where we have the right to buy shares for 77 and someone else can buy those shares from us for 79, and we just put this trade in and we close our eyes and let it go to expiration, what if the stock lands between 77 and 79? What if the stock's at 78 on the 18th of September, close of business? Well, we might choose to buy the shares because we can buy them for 77. The other party walks because they don't want to pay $79 for a $78 stock, and we wind up owning 100 shares, or 200, or 400, or 1,000, based on how many contracts we get into. So we have to be aware of that potential outcome if we allow these contracts to get to expiration. All right, but let's click confirm and send. I'm just going to do the one contract. Let's buy one vertical. This 18th of September, 77, 79 call vertical. Willing to spend up to $1.55 per share. On 100 shares, that would be $155, plus the 2 commissions to buy and to sell the contracts. So that would bring the total cost to $156.30. I'm going to send that order off and see if we do get filled. Yep, filled at $155. All right, so from here, we just need the stock to be above 79, which is where it is, even as we continue to talk here. So guys, we've accomplished what I set out to do today. I wanted to talk through a 3-step process, 3 big questions that a trader might ask themselves as they're attempting to whittle down that massive field of potential strategy candidates: bull, bear, or neutral, buy or sell, and finally reward versus probability. So I hope this has been helpful for you. This is what we do with our Tuesdays. We talk through just processes and strategies for getting started with options. I hope that you'll join me again next Tuesday. So I'm going to let you go, but before I do, just remember you have a lot of resources available to you from Schwab Education. I hope you're taking full advantage of those. Starting with, make sure that you're subscribed to our Trader Talks channel on YouTube if you haven't done that yet. So our full channel name is Trader Talks Schwab Coaching Webcasts. You can subscribe by clicking the subscribe button below the video right now. It doesn't cost anything to do that. It literally only takes a second. Click, done, you're subscribed. But this is where you can join our live streams, like the one I'm hosting at this moment. You can find playlists of previous webcasts. So if I go to playlists and scroll down a bit, it's actually going to be a little bit, well, actually this webcast series is all the way down at the bottom. Let's scroll all the way down. There's getting started with options. And if I click on view full playlist, I can see last week's discussion. This one step may reduce the trade risk by 90+%. Now, finally, you can also do keyword searches on our channel homepage and look for topics of specific interest like we did earlier with our Fibonacci's. All right, everybody, that's going to do it. Make sure that you're following your favorite Schwab presenters on social media. You can follow Kevin and me on X and on LinkedIn. On X, you can find Kevin there at Kevin Horner CS. You can find me on X at Cameron May CS. There's my handle right here. Just the profile of the guy you're looking for. But if you reply to my posts on X, I just try to reply right back to you. For example, I asked my followers recently, hey, in 2 words, tell me why the candles on this Meta Platforms chart look so weird. What's going on here? These don't look like traditional candles. Hint, because they aren't. So as you reply to these posts, I just try to reply right back to you. It allows for communication in between these live streams. Or you can also follow me on LinkedIn, and I reply to those posts as well. So like just this morning, I posted a video to X and on LinkedIn. Is Q4 really the strongest quarter of the year? Let's run a 20-year test with Thinkorswim's seasonality chart. And again, as a spoiler alert, yes, the last 3 months of the year have been the strongest quarter of the year, at least on average over the last 20 years. It doesn't mean that's the way 2026 is going to go. But if you reply to my posts here, I just try to reply right back to you as well on LinkedIn. Everybody, thanks for giving me your time. I didn't see a survey, but if you ever do see a survey, please fill that out. Thanks to everybody that's clicked the thumbs up or the like button on YouTube. That's always appreciated. It's a pat on the back to your presenter. It also gives me a nice boost in my the YouTube algorithm. Helps more people find my videos when you click the like button. So it looks like how many? Let me refresh my browser there. 71 people click the like button. That's awesome. Thank you for doing that. Guys, I will see you in a future webcast. I'll also look for you on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.